for the past 2 months.
We're not doing it here.
Morgan Stanley has been sounding the tech alarm. More voices, the better. Sounding the alarm bells here on Fast Money and on the Halftime Report. Take a listen.
Well, all we're calling for is an exhaustion of this move. We downgraded tech 2 weeks ago because all these stocks are up so much. And we've seen derating across the various markets, with the exception of 2 sectors, technology and then consumer discretionary, which you all were just talking about. And we think that those sectors are ripe to, have a correction.
Well, let's bring in Mike Wilson. He's the chief U.S. equity strategist at Morgan Stanley. It's good to see you.
That guy made a lot of sense.
Yeah, right. Okay, so you got 2 issues. You got the tech issue, which I want to talk about in a minute. But first off, what do you make of the market reacting to all these trade headlines, or not reacting more dramatically?
Well, look, the market was already kind of going that direction before the thing came out this afternoon. There was going to be some announcement. Okay, I think there's 2 ways of thinking about this. Number one, I still feel very confident that the idea that tech and consumer discretionary are the 2 sectors that still need to derate. Okay, that's one way to think about this, and that's what's going on, and we're finishing that move. The second way to think about this is, maybe you're right, Steve. Maybe this is a softening, right? Trump is pretty good at setting the thing over here, and then he orchestrates a win in the middle. And if the market's perceiving that to be less onerous, well, then you should rotate out of the growth stocks back to the industrials and some of the things that already got hit. That's why FXI didn't get hit. That's why CAT didn't get hit, because they already did. They got hit earlier in the year on fear about trade, and everybody ran into the growth stocks as a safe haven. And that's really our call this year, is that divergence between the U.S. and the rest of the world can't persist.
It's not like cyclicals, though, are killing it lately. It's been a defensive-led move lately.
That's right. So people are cramming into defensives and growth stocks because they're the safe havens in a world of lower growth. That's what you want to own, which is why we rotated towards defensives in June and we downgraded tech in July. And I think that's working. It's not working as homogeneously as people would like to see at the index level. But look below the surface. There's been a lot of damage in tech since Facebook missed in July, right? I mean, not just Facebook, across the board.
When you use the term derate, give me a little more color of what is derating? Is it materially changing your allocation? What does that mean?
No, derating just means the valuation is coming down. So this year the S&P is down 9%. The forward PEs are down about 9%. The average PE is down about 15%, the average stock. Tech and consumer discretionary are up on the year. Their PEs are still up on the year. That divergence, I don't think is sustainable. It doesn't make sense, because the reality is, if we get a 25% tax rate, even if we get a 10% tariff on $200 billion, it's going to be right at the consumer. And so I think those 2 sectors are the ones that are the most vulnerable, tech and consumer discretionary.
And you don't think it's all that short-lived, given your target being one of the lowest for the S&P, 2750.
Correct. That's a 12-month target with a range. We have a bear and bull case of 2,400 to 3,000, because you got to go back to the beginning of the year. Our view is that we had discounted a lot of this big global reflation idea from 2016. We wrote about that today. And remember last year, Scott, we were very bullish on 17. That happened, and we just felt like a lot of things got priced into January. So we think we're in a consolidation. It could last 18 months. Could last 24 months, and that range is 2,400 to 3,000. So we suspect we're going to revisit the low end of that range sometime in the next 12 months. I don't know when, but that range to us has served us well. And this is an area where you should be lightening up on some of your beta.
Are you underestimating, though, the ability to make a trade deal? What do you think a deal with China's worth?
Well, it depends on what it is. Okay. Now, if they can,
anything the market perceives to be positive, your price target likely gets blown up.
Not necessarily, because think about this. If there's a trade deal that's not a disaster, okay, it's everybody can live with it, okay? The reality is that money is concentrated into the U.S. because everybody's afraid of trade. So if you make a deal, what's going to happen? Where's the opportunity? It's overseas. These stocks in the U.S. are going to have to be sold to buy the things overseas. I don't think the U.S. stock market leads. I think you go right back to EM and you go right back to some of the stuff that's levered to global trade.
But do you think that that's really been the delta in the U.S. stock market, has been that marginal dollar that's gone away from Europe and EM? Because you could make an argument, if it's a zero-sum game in terms of global allocations, absolutely, where you want to be.
Right.
But it seems to me that the U.S. is going to do well when things are poor around the world, and it's going to do even better when things are great everywhere.
Yeah, I'm not saying that things are a disaster in the U.S., right? That's why I don't think we'll collapse. However, if there's a trade deal, okay, and things are better, and the economy continues to roll, I mean, look, next year, 19, no matter what happens, 19 is not going to be a great year for earnings growth, relatively speaking, okay? We're going to see a major deceleration in the U.S., going from sort of low 20s, probably to mid-single digits, best case, okay? That money's going to have to leave the U.S. to better opportunities around the world.
Well, you're fighting against, it's a contrarian view. I mean, there is a broad view out there that emerging markets, maybe Europe, falling knife. I mean, especially the EMs, which have gotten obliterated.
That's right. They've priced in a lot of bad news, Scott. So, look, the one scenario where EM's got to go down more is that, let's say this trade thing really gets squirrely and the dollar gets even stronger because people even cram further into the U.S. We could have, a real, acceleration in this sell-off. But believe me, the U.S. will get caught in that boomerang if that's where we're going, okay? And that's why these two sectors, in particular tech and consumer discretionary, are the ones that still have to derate or see their valuations come in. Once that happens, by the way, then we can actually move forward, I think, in a much more constructive manner.
Always appreciate your point of view. It's good to see you.
You too, Scott.
All right, Mike Wilson, Morgan Stanley. We can trade it.
Courage of his conviction. So effectively what he's saying is the trade here, almost regardless, is emerging market weakness. It's probably everything's priced in, you buy it, and the mean reverting trade is the S&P at a certain point catches up to the weakness of EM. That's what we've been talking about in terms of outcomes. That's a potential outcome. 2,400 is 15% or so from here. I think under worst case scenario, you could absolutely see that.
I tell you what, I'm an EM guy. I just don't see it, And if anything, I think there's a risk to the dollar going higher out of a solving of the trade news as the differentials get bigger in this country. And I think the dollar could rally on a flight to quality. So I worry about China. They're the biggest weighting. China's not going to fall apart. They can do whatever they need to do to stimulate, but they're the biggest weighting in EM. I'm not running back.